Welcome to Market Deep Dive, where we analyze companies and market trends to help you better understand the financial landscape. I'm Viraj, and with me is Prakash. Today we're diving into Shriram Finance, a significant player in the NBFC sector that's been making notable moves in the market.
Thanks, Viraj. Today's analysis is particularly interesting as Shriram Finance has recently announced a $1.25 billion offshore loan initiative and completed a significant stake sale in their housing finance arm. Let's break down their performance across segments and understand what these moves mean for their business model.
Looking at their Q2 FY25 performance, the numbers tell an interesting story. Total disbursements reached Rs 39,974 crores, with a 15.51% year-on-year growth. Breaking this down by segments, commercial vehicles led with Rs 15,004 crores, passenger vehicles contributed Rs 7,595 crores, and their MSME portfolio saw disbursements of Rs 6,875 crores. What's notable is their strategic focus on used vehicles, which has shown better resilience compared to new vehicle financing.
Their asset quality metrics are particularly noteworthy. Gross Stage 3 assets improved to 5.32% from 5.79% year-on-year, while net Stage 3 assets decreased to 2.64%. This improvement comes despite industry-wide challenges, particularly in the commercial vehicle segment. Their credit cost has also improved to 1.84% from 2.02% in Q2 FY24, indicating stronger risk management practices.
On the product mix, let's dive deeper into their gold loan portfolio. They've strategically reduced LTV ratios to 60-65% from 70-73%, showing prudent risk management. While this impacted growth with the segment showing 12% year-on-year growth, it positions them better for sustainable growth. The two-wheeler segment saw disbursements of Rs 2,025 crores, while personal loans stood at Rs 2,081 crores, reflecting their diversified approach.
The technical indicators present an interesting picture. Trading around Rs 2,282, the stock shows mid-range momentum compared to its 52-week range of Rs 2,016 to Rs 3,652. The relative strength index indicates price weakness, but the volume analysis shows steady institutional interest. Notable is their low beta of 1.53, suggesting higher volatility compared to the market.
Their funding profile deserves attention. The liability mix includes 24% term loans at Rs 51,123 crores, 16% securitization at Rs 34,467 crores, and notably, 24% retail deposits at Rs 5,196 crores. The recent move to raise $1.25 billion through offshore loans demonstrates their ability to diversify funding sources. Their cost of funds stands at 8.97%, with a healthy liquidity coverage ratio of 234%.
Looking at their operational metrics, the net interest margin of 8.74% remains robust despite competitive pressures. The cost-to-income ratio at 27.95% reflects operational efficiency. Their employee base has grown to 77,764, indicating continued investment in business expansion. The ECL parameters show Stage 1 PD at 9.06% and Stage 2 PD at 20.98%, with LGD at 38.59, suggesting conservative provisioning.
On the risk front, key factors to monitor include their exposure to used vehicle segments, which, while performing well now, could face pressures in an economic downturn. Their gold loan portfolio's reduced LTV provides a buffer, but competitive intensity in this segment remains high. The MSME segment, while growing, needs careful monitoring given the broader economic cycles.
The shareholding pattern shows interesting dynamics. Promoter holding decreased marginally to 25.40% in September 2024, while mutual fund holdings increased to 10.64%. FII-FPI holdings stand at 53.70%, with the Government of Singapore holding 6.4% and Kotak Mahindra Group at 2.87%. This institutional backing provides stability to their ownership structure.
Looking at their forward growth drivers, the management expects CV portfolio growth of 17-18% in coming quarters. Their strategy of focusing on used vehicles, where they see better asset quality and returns, seems prudent. The personal loan segment, currently conservative, might see expanded growth once market conditions improve. The recent sale of their housing finance arm for rupees 3,929 crore to Warburg Pincus should provide additional capital flexibility.
Price performance metrics show a YTD return of 40.41% and a 3-year return of 144.83%. The stock currently trades at a PB of 2.22 and TTM PE of 13.49, below the sector PE of 28.81. The company's PEG ratio below 1 suggests potential value at current levels, though investors should consider the cyclical nature of their business.
The Asset Liability Management, ALM, shows cumulative surplus of over rupees 35,000 crores up to 6 months and rupees 50,000 crores up to 1 year. Their incremental cost of funds has been in line with balance sheet costs, suggesting stable margins ahead. The recent dividend announcement of 220% and stock split from rupees 10 to rupees 2 face value indicates management confidence.
Analyzing sector dynamics, Shriram Finance has maintained better asset quality compared to peers, particularly in the vehicle finance segment. Their conservative approach in personal loans, focusing on existing customers, has helped maintain portfolio quality. The gold loan strategy, while impacting growth, positions them well for sustainable returns.
Before we wrap up, it's crucial to note that while the company shows strong fundamentals, the NBFC sector faces inherent risks, including regulatory changes, interest rate movements, and economic cycles. Investors should conduct thorough research considering these factors along with their investment objectives.
That's right, Viraj. Shriram Finance presents a case of balanced growth with focus on asset quality. Their diversified business model and strong risk management practices position them well in the NBFC space, though market conditions will remain a key monitorable.
Thank you for joining us on Market Deep Dive. Remember to subscribe to our podcast for more such in-depth analyses of companies and market trends. Until next time, this is Viraj and Prakash, signing off.